Hey guys, welcome back to Financial Markets. Hope you're all doing well. So something I haven't talked about in this YouTube channel actually, I thought it would be a good idea to do so, is I've spoken a lot about equities and stocks, which is where you basically should start your portfolio investing when you do start. FX I've touched upon, but I've never spoken about the bond market. And I thought it would be a good idea to talk a little bit about it today, because there might be some of you that do invest in the corporate bond market, and even if you don't, and you could potentially decide to get some bonds as a part of your portfolio that sort of gives you consistent yield and returns. So basically it's like a dividend income stream, if you will. And so I'm using basically Hargreaves Lansdown website, which is basically a UK broker. This video is not sponsored by them. I wish it was, but it's not. But they are a really good, reputable UK broker. Anyway, so they have a corporate bonds page, so you can see gilts. These are UK gilts, by the way, and bonds that are listed in GBX, i.e. sterling. And so I thought it would be a good idea to discuss a little bit about how the bond market works and what is it used for. So firstly, just to begin with, the company raises money through two ways, and that's through equity or through debt. And so equity, as you all know, is through stocks. So they give out these shares, when you buy a share, you basically own a small portion of a company. And debt is basically a way they issue it by saying, okay, you give us money technically on a loan, and we will in return give you a yield, i.e. what the interest rate or whatever they decide the yield is as part of the interest rate, and then that will be paid to you as basically a coupon payment until maturity date, when we owe your money back. It's like owning a 5-year contract with the bank in terms of a bank loan, and then we'll pay your money back. Now, yields depends, as you can see here. Some are 5%, some are 7%. I think some are even higher, 10%. But they depend on, one, the maturity deadline. Obviously, people would decide to sometimes sell a lot closer to the maturity. So they sell a lot, and when you sell a bond, then the yields go up because the value of the bond has gone down. And in some cases, the reason why it's higher is because that the bonds are actually rated a lot lower. So with corporate bonds, they have a credit rating, which credit rating companies such as Standard & Poor's, Moody's give a rating to them. So it could be anything from AAA to like C grade bonds. And so the lower they give you, the more they're trying to say it's more risky to hold, because one, they might not be backed enough by the company's assets. Second, the company might just be in a turmoil situation, so they might say, okay, look, this is why we're giving it a low rank, because you could go bust tomorrow, and your debt, your people that are holding your bonds could easily lose their money. Hence why that is important to always look at. And so like if we see the 10% one that we just saw, it's Barclays one. As you can see, the reason why it's now 10% is because it's literally maturing in 2 years. So everyone's basically just selling out before the maturity deadline, because they don't want to really hold it and see if Barclays will actually issue out the money. They'd rather just sell it off and take the profits that they made that throughout the years, and just take over the money. And so let's have a look at one of them. In fact, so let's see a longer date one. Let's do a maturity. It's a bit longer dated. So yeah, this is 2057. So Tesco one. So Tesco, a big brand that we all know about in the UK, where we go and buy our groceries, our everyday needs. And so they're issuing bonds at about 5%. And so the bad thing sometimes with about some of these ones is this. Look at this. The minimum investment size, they give you about 50,000. So for certain retail investors, that's just too much money to fork out. And you think, I don't really want to fork in 50,000 in a bond. That's one, illiquid, hence why there's no online trading, by the way, because bonds are actually considered quite liquid, especially compared to equities, where you can literally just log on and sell in a day. Bonds are not able to do that. So they pay the coupon frequency biannually, i.e. every 6 months or so. Every 6 months they pay the coupon, and they pay 5.2% yield. And this is a fixed coupon. So some you can get is variable. So fixed coupons, basically they tell you, okay, look, we're going to pay a 5% interest rate, interest on the bonds, on the debt, and you'll get that. But if it's variable, it depends on how the interest rates move from the central bank. So in this case, it'll be the Bank of England. And normally bonds are issued at roughly £1 a share. Sorry, £100 a share. It's normally what bonds are issued. I don't know why it says penny here, to be honest. But anyway, that's incorrect. They're normally at, they all start about £100 a share. Anyway, so right now the running yield is about 4.492, and the reason being for it is because obviously it's appreciated a lot in value. So obviously as the corporate bond price goes up, the yield will go down. So naturally, if I issue a bond at £100 a share for 5%, if the bond goes to 10, if it rises 10%, i.e. £210 a bond, then the yield that the person that will buy at the time would get is 5% decreased by 10%, which will be about 4.5, 10% of 5%. What am I doing? 4.5%. Sorry. So that's what happens, and that's what happened in this case. It's around 4.5% because it's increased by about 10% from its initial offering price, and so that's how basically these work. And redemption date is the date at which they will basically give back your money, and close off the debt security and give back the money. And so yeah, I thought it'd be a good idea to show you this video. Oh yeah, and also the ISIN is something really important. You can go to Standard and Poor's or Moody's website and literally type in the ISIN, and you can get the credit rating for this corporate bond, which obviously will give you an idea whether or how risky and how not risky it is. But anyway, I thought this video might be helpful to you. Please leave a like, comment, and subscribe. And I'll see you guys in the next one. Bye.